Hey everyone, my name is Kenji, and in this video I want to explain how to get started with investing. So if you're looking to gain some financial literacy or know what to do with your own money, this is the right video for you. It's essentially the video that I wish I had when I first started investing a couple years ago. So what even is investing? In short, investing is just using your own money to buy things that you hope to sell for more in the future. That might be a house, it might be a share, it could be a cryptocurrency, it could really be anything, and we'll get into that throughout the video. And as a bit of a disclaimer, I'm not a financial advisor, this is purely for educational purposes and hopefully there's some takeaways for you. So now that we know what investing means, let's look into why you should invest. Why not just leave your money in a bank account or put it under your mattress for all I care? There's nothing wrong with that, right? Well, there's this thing called inflation, which is essentially the rise in prices throughout the years. And that's typically around 2% in developed nations. So that means that every year prices rise around 2%. One classic textbook example has to do with milk. About 100 years ago in 1913, milk used to cost around 36 cents per gallon, whilst nowadays in 2013, say, it costs around $3.5 per gallon. And now that rise has to do with inflation. So basically, if your money is not growing, if you just left it, say, under your blanket, then essentially because of inflation, the value of your money is actually going down over time. And you might argue, hey, I leave it in my bank account, I know that the bank pays interest. And that is true, but today, the interest rates that the bank gives you is around 0.2%. And comparing that to a 2% for inflation, well, you're still losing money, right? The other main reasons you might want to invest has to do with compounding interest. As Einstein put it, it's the eighth wonder of the world. So in an investment, compounding interest means that you earn interest on the amount invested, and then later on you also earn interest on the interest. I know it sounds a bit confusing, so let's look at an example. So for example, say I have $100 and I've put it in a saving account that's going to give me 10% a year. 10% a year doesn't exist in real life, it's just for this example. So after 1 year, the 100 turns into 110, right? After 2 years, the 100 turns into 121. And the reason is that 10 that you earned between year 1 and year 2 has gotten interest as well, so that earned a 1. So now it's 121. And then if you fast forward this to say 5 years on, that turns into 161. And in 10 years time, that turns into 259, say. And then that kind of rises exponentially, and that's compounding interest in action. So you can really start to see this snowball effect where the earlier you invest, the faster and faster it's going to grow over time, right? So now that we understand why we should invest, let's look into the different types of investments we can make. There's really four main big categories. The first ones are shares, second ones are funds, then bonds, and lastly we'll talk about property. So what is a share? A share is basically being part owner of a company. So if you buy a share in Apple, say, that means you're part owner of Apple. And so there's two main ways that you can make money with shares. The first one has to do with capital gains, and that's essentially if you buy at $5, say, and that rises to $10, the difference between the 10 minus the 5 is your profit. That's how you can make money. And then the other way that you can make money is through this thing called dividends, which essentially when a company makes profits, sometimes they distribute it out to their shareholders, and you might be one of those shareholders, so they'll give you some money every single year if they're profitable. Now, dividends are not guaranteed, and most companies, well, a good portion of companies don't actually pay dividends, and that's maybe because they're not profitable so they can't afford it, or for other reasons like maybe they prefer to just invest the money somewhere else. So next up we have index funds. So instead of putting your money in one company, say, through an index fund, you can put it in many different companies. So for instance, in the US, a big index is the S&P 500, which is basically the 500 biggest companies in the United States. Another big one is the FTSE 100 in the UK, as well as the Nikkei 225 in Japan. So for instance, if you decide to put your money in the S&P 500, that means you've essentially bought all 500 companies in different proportions depending on their weight. So basically, the bigger the company, the more weight it's going to have out of those 500. So if you put $100, you can see here that Apple has a weight of 6%. That means that $6 are going to go into Apple. Next up is Microsoft, so $5.5 are going to go to Microsoft, and so on and so forth. In the future, if Microsoft, say, went up a bit and they became bigger than Apple, then the weighting would change and your amount invested would change. And so the fund essentially works that out for you and it does all of the investing for you. So you might have also heard of ETFs, exchange traded funds, and they're essentially the same thing as index funds. The main differences have to do with some have minimum entry requirements, the tax rates are somewhat different, And also, usually in some of them, you can only invest throughout the day, whilst others you have to invest after the market closes. I'd also add that in these funds, usually you have to pay a certain management fee, which is usually around 0.2%, so it's really minimal, but it's basically for the fund manager to continue managing it, right? Now, within this world of funds, I mentioned there's some in the UK, some in the US, some in Japan, but there's really a whole world out there. There's some that invest only in tech, a fund focused on tech, a fund focused on healthcare, say, a fund focused on India. There's really all sorts. So next up we have bonds, and much like the bank might lend me money to buy a house, say, I can lend a company or a government money as well. And so how that works is I lend them money and in turn they give me an interest. So every year they pay me a certain amount, which is called a coupon. And then at the end of that loan, they're going to pay me back the principal. So the initial amount I gave them, right? That's another method to invest. And just to give you guys an example, look at Apple here, for instance. They sold about 14 billion of bonds recently. And so it's something fairly common among big companies. And overall, I would say that bonds are not quite as popular as stocks for personal finance. And I'd say that's mainly because bonds are somewhat trickier to understand for people. Now, historically, stocks have had higher returns than bonds, but they're also riskier. Usually a stock is much more volatile, so it goes up and down a lot, whilst a bond is generally fairly stable throughout. And then lastly, we have property. So there can be residential or commercial property. And on the whole, you can make money by two main ways, which is essentially the same as shares. One has to do with capital gains. So you might buy a 1 million and sell it at 2 million, you make that gain. And then the other one has to do with rent, right? You rent it out to someone and you get a monthly, say, $2,000. But unfortunately for most of us, property is rather expensive. So it's probably not the starting point. You probably start with shares, bonds, or something that's not as expensive. And in finance terms, that group of assets that you own is called a portfolio. So you might have a portfolio of stocks and bonds. You might have a portfolio of properties. It's just the finance parlance, really. So you've probably thought of investing before and you might have read that it's actually very risky. So let's look into really how risky it can be and how to reduce that risk. So a general rule of thumb is to only start investing once you have about 6 months worth of salary saved up. And I think that makes sense in case you lose your job, for instance. Alright, just to get it out of the way, things will always be risky to an extent, but there are some ways to reduce that risk. And that's through diversification, which is essentially not putting all your eggs in one basket. Let's look at an example. Suppose you have Apple shares, right? If you only own Apple shares and something happens to Apple, then you're going to lose all of your money, right? Whilst if you own, say, 4 different shares, you might own Microsoft, Google, Facebook, and Apple, then even if something happened to Apple, you'd still have the money in the other 3 shares, right? And then you can extend that further and say, suppose you own the S&P 500 index. Now you own 500 different shares, so if something happens to Apple, like we saw earlier, that's only 6% of your total. So you still have the remaining 94%, so no problem there. And so on and so forth. And then you might think, well, I'm only in the US here, so what if something happens to the US? Then I can diversify by investing in India or in the UK, and so on and so forth. So even if some investments don't do well, they're neutralized by the positive performers. And overall, this is probably the safest way to go forward and the best way to reduce risk. And as a general rule of thumb, people like to have their investments in safe things for around 90% of what they own, and then they might have, say, 1 to 10% in risky assets. So that might be things like cryptocurrencies or emerging markets, things like that, that could be high reward, but even if you do lose that money because it's risky, it's not really going to hurt you too much. Alright, so now that we understand the risks involved, let's look into how we can actually invest. And I'll be focusing mainly on shares, bonds, and funds. That's mainly because for property, typically you need a lot more money, let's say 100,000 or more. And so that's usually not the case for everyone. And you can probably find your local broker if you want to do that. Probably the simplest way to invest is just through your bank. So wherever you have money saved up, that bank, say Lloyd's in the UK or Bank of America in the US, they typically have brokers themselves. So if you look through their website or their app, they're probably going to have a section that says investing or buying stocks or something like that. But there's one big but with banks. Usually they tend to have fairly high commissions. So basically every time you buy a share, say I buy $100 of Apple, they're going to take, say, 1%. So they're going to take $1. And then when I sell that share, they're going to take another $1. And so if I do that, say, 10 times a month, then that's really a considerable amount that they're starting to take in commissions, right? So there's usually some cheaper alternatives, luckily. So here's the main ones. In the US, say, Charles Schwab, Vanguard and Fidelity are some of the main ones, and there's some newer ones like Robinhood and eToro as well. In Europe, unfortunately, there's not as many options, but some of the main ones include, in the UK, Vanguard and Fidelity are also there. In Europe, I personally use this one called the Giro. There's some other ones like, say, XTB or Free Trade. And as for how much money you need to start, you really don't need much. You can just start with $20 if you feel very scared about it, or you can go ahead and put in $1,000. It's really up to you. And overall, the earlier you invest, the more of the compounding effect that you're going to have. So probably the better off you'll be if you do your investments wisely. So yeah, that's investing for beginners. I hope you found it useful. If you did, feel free to like and subscribe, and I'll hopefully catch you in the next one.